Okay, welcome to bank reconciliations. We're going to quickly go through a question on a bank reconciliation, and I need to just clarify some basics. One is that the cash book is what the business keeps, is the business's idea of how much money they have in the bank without looking at their bank statement. So there's going to be a balance, a figure here in the cash book that the business thinks they have this much money in the bank, and what items have come in, which payments have gone out of the bank. Now there's going to be some items that happen that the bank isn't yet aware of. So for example, we might receive a check from a customer and put it into debit the cash book, and if you're unclear about debits and credits, we're going to have to go back and look at how they work. But we will debit the cash book because we see the bank account in the cash book as an asset, and assets increase on the debit or left side, and assets decrease on the right side or credit side. So if we receive a check, the bank asset increases, so we put it on the left side, the debit side, and if we make a check payment to a supplier, we put it on the credit side or the right side, because obviously a check payment means that our asset of bank is decreasing. Okay, so that goes there. And then obviously there'll be things that happen in the bank that the business is not aware of, and so the bank will send us a bank statement that represents their understanding of how much money we have actually in the bank. And there'll be things that happen in the bank that they might make payments out of our bank account, such as direct debit payments or standing order payments. We might have to pay a fee or an interest charge because we've gone overdrawn. We might even receive interest because we've got a balance of money in our account and we might get rewarded for that. Or that somebody might do a direct credit transfer into our account and we would not be aware of it in the business, so it wouldn't be in the cash book, but that money would be received in the bank and therefore show on the bank statement. So a bank reconciliation is where we tie up the balance that the business thinks we've got in the bank with what the bank says we've got in the bank. Obviously there are these differences, and if we can account for those differences, the two figures, balances, should match up. Now if we do all this and they don't match up, that discrepancy basically means there's either been an error or some fraud or something to actually look into and resolve. Okay, so there's 3 steps to doing a bank reconciliation, and they are: number 1, we tick the items that are common in both the cash book and the bank statement. Number 2, we update the cash book balance, so we find out how much we think is in the cash book, and then we update that with items that were unticked in the bank statement. In other words, the items that we weren't aware of, and they will come into here and we'll work out a new balance. And number 3, we do the bank reconciliation statement after all this, where we take into account items that were unticked in the cash book that the bank wasn't aware of. And at the end of that, the two should tie up. Now this question includes 2 errors essentially as well, so you can see how we handle those. Check 522631, which is in the bank statement as a payment of 4,600, is an error at the bank, is not supposed to be there at all. So that's an error, we'll take account of that. And there's another error because we have a check 123,599, which also appears in the bank statement 123,599, but in the bank statement it shows as 165, and in our cash book it shows as 156. And unless otherwise stated, we would assume that the error is on the business's side, because the bank has a double check system, so they are less likely to be wrong, although it's possible, but in this case we're assuming that the business is wrong. So we have an error here with the 156 that we are wrong, and there's an error at the bank where they've made a mistake. So we can see how both of those are also dealt with, in addition to doing hopefully a simple type of bank reconciliation. So we're going to go through the 3 steps, and let's start with step number 1. We tick the common items in both. And also, just to clarify, the bank's perspective on money is reversed essentially to ours. So it's probably better if instead of debit credit in the bank, we just make a change and say credit essentially means money has come into the bank account from the business's bank's perspective, and debit means money has gone out. Okay, so I'm going to refer to, when I talk about the bank statement, I'm just going to refer to monies come in or out rather than the words debit, credit. But when we're looking at our business cash book, I will be referring to debit, credit, or left and right. Okay, so let's make a start. Now, the first thing we've got to check is that the cash book and the bank statement, the bank essentially are starting at the same place. So we have a brought down balance on the credit side, on the right hand side in the bank account. In the cash book, the business's perspective is that we have a minus. This basically means we have a liability that we're starting with because the brought down's on the credit side. Whereas with an asset, the value at the beginning is supposed to be, like we could say, supposed to be on the debit side. Okay, so we're starting with a liability or a minus, and if you look in the bank statement, we've got 100 debit, according to their terminology at the bank. They're calling it debit, which essentially means we're minus. So that's a minus balance. Okay, so the starting point is the same. Another thing you've got to realize is that 100 starting point happens after this transaction of 245 that went out of the bank. So that 245 happens before the start of our bank reconciliation. So we need to start in the same place at 100 minus and 100 minus. So the 245 happens before that, so we can ignore that figure there. So we're not going to take that into account. So we're starting at 100 in both cases. Number one, we're going to take items that are common or the same in both. So let's look at this side. We have a 358, that money has essentially come into the business, and there's a 358, money has come into the business, okay, business bank account. And then we have an 82, credit transfer into the business, 82, and that matches with this 82 over here, so tick the item. And now, remember, we're ticking the amounts coming in and out of the business, and as we are here, we don't then need to look at the balance figure at the end. We can ignore that. We're just looking at monies coming in and out and seeing if they match with what we said. Then we have this 2486 coming into our business according to our cash book, but I can't see that over there, so I'm going to leave it unticked. We move to the other side. I have a 275, which is not in the bank statement, so I'm not going to tick that. I have a 156. Now that check number that ends 599, check number that ends 59 is supposed to be the same payment. That's the same payment. It's supposed to be the same amount. It's not. So there's been an error, and unless there's other information, we're going to assume that the business has made the error, and the cash book, which is the business's version of what's in the bank, is incorrect. So we need to correct the cash book. So if the cash book of the business is wrong, we will correct or update the cash book and correct that. If the bank is wrong, we do not update ourselves. So if the bank has made an error, we don't introduce that error into the business's account of how much is in the bank as well. We don't want to introduce errors where they are already not existing. So if there's an error there, we do not introduce it here. But there's an error here in the 156, so I will need to account for that. So what we have is a payment that we're showing of 156, and according to the bank statement and the bank itself, that is supposed to be 165. So this is wrong, this needs to be 165. So essentially we're showing that 156 went out of the business, but it should have actually been more. So what we'll need to do is adjust for that. So if we look at how much is the value in the cash book at the moment, we look at both sides and we see that this side is a larger total. 358, 82, 2,486 is larger than what's on that side. So the total of the left hand side, the larger side, is 2926. So I put that into both sides, 2926. Now, the right hand side, the credit side, doesn't quite add up to 2926. There's a missing number, and the way we work out what that balance is that we take the total 2926 and minus the numbers that are already there, all four of those. And then if we do that, we should get a figure of 2358. And then since that's the carried down balance, we'll obviously bring it down on the other side, 2358. So currently we have, according to our business's perspective, they think that we've got 2,358 in the bank at the moment as a positive balance because the brought down is on the debit or left side, which is where assets are supposed to have their brought down balance, let's say. Okay, so that's the current figure. Now, since we said the amount we took out of the cash book doesn't match and is incorrect, this is supposed to be 165, so we are short by 9. So what we need to do is take 9 off our current balance. And we reduce this asset by, if you look at the arrows, by putting a number on the credit or right hand side. So I'm going to put 9 here and just say, I might say error correction. Okay, just to correct the error, I'm going to put it there. So there's a 9 to correct or reduce this amount down. In accounting, we reduce figures by putting a value on the other side, counterbalance, whereas we increase values by putting more numbers on the same side. So since we're trying to reduce it, we're putting a 9 on the opposite side to reduce that down. Okay, so we're just going to carry on doing what we're doing. Now, since we have now corrected for that figure, the 156 essentially matches, and with this, the 165. So basically the two, now the values are matched. The 9 with the 156 matches with what's over there. So therefore that we could say that is in both. We can see that in both now that we've corrected it. Then this 37, I can see a 37 as well. 37 has gone out of the business bank account, and we can see that in the bank statement it has indeed gone out. Okay, so I've ticked those items. I'm trying to look for any more items that could be there. That's it, that's all I can see. So now we've done step 1, ticking the common items. We need to do, or complete, because we already started a little bit of it, updating the cash book balance. So the cash book balance currently, after all the transactions that we are aware of, is 2,358. We need to now correct that or update it with items or transactions that have happened that the bank is aware of and we were not aware of. And that's going to be items that are here that are not ticked, because the items that are ticked are also here, and therefore the business is aware of those. But the items that are unticked are the ones that the business is not aware of, and therefore we need to use those items to update our own cash book, our own business's understanding of how much is in the bank or not. So now the 4,600 is in error. So that is an error on the part of the bank. It's not really supposed to be there. So what we're not going to do is we're not going to introduce that, because that's a mistake and shouldn't actually be in the bank statement. So we're not going to introduce an error into our system. Okay, so ignoring that, we're going to account for any other numbers we see. So what we have is a 45, that's an amount that's gone out of the bank, some cash that's left the bank. So we need to also update ourselves with that same fact. So the asset of bank decreases on this side because money is going out. So I need to then put also 45 more on this side. And that is interest. Okay. And you can, if you want, put the date. Okay. Then we also have, so that's now takes care of that figure. And then we have 650, which is also not ticked. That's a payment that's gone out of the bank. So we need to therefore put it on the credit or right hand side of our cash book to show a value going out of the business. So that's 650 will also be there, and that is a direct debit, and we'll put the date of that as well. Okay, now that takes care of that. So, and this was an error which we'll deal with later on. So everything that we can deal with has been dealt with. So essentially we've updated the cash book. We now need to know what is the new balance in our cash book after we've updated it with the new information. Okay, so we do the same thing. We look at the balance we started with, or our current rolling balance presently is 2,358, and then we have amounts that have come out. There's no amounts that we had to add in on the left hand side. They could have been if there were unticked items under the we could say in the bank statement, then we would have added some figures on this side too, but there were none. So in this case we need to now balance this off. So we have 2,358 starting. So now we can kind of say ignore what happened above, because all of that is rolled into this balance 2358. That's our starting figure. That's what we as a business think is in the bank account at the start. We've now updated ourselves with further information. So again, like we did before, at the top, the left-hand side balance is bigger than what's on the right-hand side. So we use that as the total, 2358. And we use that as a total for both sides, 2358. Okay, so now we need to work out what the balance is, how the value is on this bank account now. Because we started with 2358 and we minus 9, 45 and 650. So there's going to be less than 2358. So if you balance this off, the total is 2358 on the left, on the debit, 2358 on the credit, the total, but we need to work out the balance, so how much is remaining. So 2358, and we have to minus 1, these three figures, and then that will give us a balance to carry down, or at the end we might say. Okay, so, and then that will also be the same as the balance brought down at the end. Okay, so we're just going to do that. Okay, I've now balanced that cash book off, and we see that we now have an updated cash book balance of 1,654 on the left hand side, which means it's an asset. We have a positive balance at the bank. And lastly, step number 3, we do the bank reconciliation statement, which looks like this. So that we start off with balance as per or from my updated cash book, which is a positive 1654. We add unpresented checks. Now, the only items that are unticked are the ones in the cash book, more or less. So, unpresented checks are the items on the credit or right-hand side of the cash book that are unticked. And apart from the carry-down figure, which was a calculation, the only unticked figure is this one, 275. So we're going to add 275. Now, that has also been dealt with, so we can cross that off. We minus outstanding lodgements or receipts. So these are items on the left-hand side, the debit side of the cash book, that are unticked. So this one, 2486. 2486. We're going to minus that. So if you take 1,654 and you minus, you add 275 and you minus 2486, it's not quite going to add up to what the bank says should be in there at the end, because there's an error at the bank. That error is shown as money going out. So the bank is actually much lower balance because they've shown an extra 4,600 balance figure going out of the bank. So we need to adjust for that. So if we also minus 4,600 as the bank error, and we deal with the bank error not in the cash book, we don't introduce an error at the bank into also our business. We deal with it here. Any errors in the business we deal with in the cash book, and any errors at the bank we deal with in the bank reconciliation. So now if we start with 1,654, we add the 275, the figures on the credit side of the cash book that were not ticked, and then we minus lodgements, figures on the left hand side or the debit side of the cash book that were unticked, and then any error that's left, which is now dealt with that, and that should, if you do the maths, that should come up with 5,157 minus. Now you can see at the end, the 5,157 minus matches the minus that the bank says we have in there. So now that we've accounted for everything, we can see that the cash book does reconcile and match with what the bank statement says we have as a balance. So that basically gives us confirmation that there's no other transactions and probably no other fraudulent transactions that we're not aware of. Okay, I hope that explains the process of bank reconciliation. If you like what you've seen, you can access my full course on Udemy, where we go into not only bank reconciliations into a lot more detail, but all the other topics that you may want to come across.